with a video today, a quick video on opportunity cost and what it is. Oftentimes this is a huge principle financially that's looked over, but let me talk just a little bit about what it is. Now, the definition of opportunity cost is the exchange and the loss of value by making one decision over another. So let me reiterate that by saying it is the cost of making one decision over another. So let's just say for right now, you've chosen to watch this video, okay? Well, that 5 minutes of your time, you're never going to get back. You could have done something else with that 5 minutes, but you can't do really two things with that. You can only do one thing. Now, when it comes to finances, the real difference and the real opportunity cost that's lost financially is usually in paying cash versus letting our money or spending money versus compounding. What I mean is, let's say that you have $25,000. Now you have two options with that. You can let it compound and you can invest it, or you can use that money and you can spend it as cash and you're never going to see it again. This is where infinite banking and whole life insurance really come into play to give us the best of both worlds. What do I mean by that? Well, if we use our money, we lose the value. If we let our money compound, we can't use our money, right? Well, not really. And this is why. In a whole life insurance policy, we could put that $25,000 in there. Now what we're going to do is we're going to let this money compound for the rest of our lives. But what if we need that money? Well, what we're going to do is instead of taking this money out in cash, we're going to take a loan from the life insurance company. Now, they're going to charge us a percentage of interest, but we're also going to be earning that percentage of interest. So what does this do? This solves our opportunity cost. When we use our money, we're paying for it with interest, but we're making sure that we earn that interest on our side. When we're not using the money, it's also earning interest. Over your lifetime, over a 30-year period, letting your money compound in a whole life insurance policy, let's say this $25,000, it's going to add up to about $100,000 of money in your life insurance policy just by doing this one simple thing and changing the way you look at money and letting your money compound throughout the rest of your life. Over here, this guy, after it's all said and done, he might have $25,000, he might have $0 because he spent it all. He saves it up again, he spends it again. He never lets his money compound. So the compound interest factor over here is what really matters in opportunity cost. Now let's talk a little bit about compound interest really quick. How does compound interest work and why is it so powerful? Well, with compound interest, we have to understand that it's going to grow on itself. So let me just finish erasing this really quick. Now, compound interest, like I said, is going to grow on itself. So there's two kinds of interest. There's simple interest and there's compound interest. Simple interest is like when you take a loan, like a home loan or a life insurance policy loan. What's going to happen is you're going to pay the majority of the interest up front. What happens? Every year your balance gets lower and lower because you're paying down that balance, and you're going to pay less and less interest as time goes on. But what's happening in compound interest? Well, we're going to earn less interest up top, but what's going to happen is as time goes on, our interest is turning into principal, and that principal compounds on itself. So compound interest in the end is going to have a much bigger effect on our portfolio than paying cash or anything else is going to do. So by letting our money compound, we don't lose out on our opportunity cost. We're going to have a lot more money to show for it in the long run by taking simple interest loans and letting our money compound. Hopefully this